Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. We're a $500 million investment firm based out of Albany, New York. And the topic we're going to be covering today is when a child has investment income, at what level of investment income does that child need to start filing a tax return? And this happens most frequently when we have clients that are shifting assets down to the next generation, essentially their children. They're setting up accounts or individual accounts and taking advantage of those gift exclusions every single year. But as those accounts get larger and larger, they start creating more and more investment income from dividends, interest, and potentially long-term and short-term capital gains. So what we're going to be covering today is how do these UTMA accounts work? How do the standard deductions and tax rules work for minor children? You also have to be aware of the Kiddie Tax, at what point that triggers the investment income to be taxed at the parent's rate as opposed to the kid's rate, and then also the gifting rules to take advantage of those annual gift exclusion when parents are enacting these gifting strategies that are essentially funding these investment accounts for their children. When clients begin gifting assets to their children, they usually set up what's most commonly an UTMA account, which stands for Uniform Transfer to Minors Act. And these are the accounts that are built in the Social Security number of the child, but the parent serves as the custodian, which means they have full control over the account until the child reaches age of majority. We have some clients that with larger estates that do set up trusts and make completed gifts to a trust, but you have to be very careful about what type of trust you create. When parents begin gifting assets to their children, instead of having this money just accumulate in a savings account, a lot of times they do want that money invested so they can benefit from the appreciation while they're waiting for their kids to use it at some point in the future. And the two types of accounts our clients typically set up is UTMA accounts, which stands for Uniform Transfer to Minors Act, which are these accounts are established in the Social Security number of the child. So when you make a gift to these accounts, it is a completed gift because it's going to the child, but the parent serves as the custodian of this account, which means they have control over the investments, distributions, all that stuff until the child reaches age of majority for the state that they live in, and then the child has full control over the account. There are some clients that go a more elaborate route and set up special trusts to make gifts on behalf of the children to create those completed gifts, but that's a more complex structure. For UTMA accounts, when we talk about the age of majority, which is the age the child reaches that they have full control over this UTMA account and the parent is removed as a custodian, it does vary state by state, but it's also important to understand states can have an age of majority for UTMA accounts specifically and age of majority for everything else. In New York, our state is exactly that way. So age of majority in New York State is 18, but age of majority for purposes of ownership transfer of UTMA accounts is actually 21 in New York State. After a parent has set up one of these UTMA accounts, they can begin making gifts to the account, and they are completed gifts in the eyes of the IRS. So you may know that the annual gifting exclusion amount for 2024 is $18,000 a year, which means you can gift $18,000 to any number of people, including your children, and it doesn't count towards your lifetime exclusion gift amount. So I could actually gift my child $50,000 in a given year. No one owes any gift tax, but the amount that's over and above that initial $18,000 counts again by lifetime exclusion, which are actually very, very high right now. At the federal level, I think it's around $13 million I have to give away before anyone owes any gift tax, and it's about $7 million at the New York State level because federal has gifting lifetime limits. States can have separate gifting lifetime limits, so you have to be aware of both. For a married couple, you each have $18,000 a piece to gift to any one child. So if let's say me and my wife have a daughter, I can give $18,000 to the UTMA account. My wife can then give $18,000 to the UTMA account. So that's $36,000 in total. And we don't have to file any gift tax returns for those gifts that were made to fund that account. Now that this UTMA account has been created and is creating all this investment income potentially from dividends, interest, and capital gains, at what level of investment income does that minor child need to start filing a tax return? And the answer is if they are a minor child claimed as a dependent on your return as the parent, it's usually around $1,250 because that is the standard deduction for unearned income for a minor dependent. So any investment income under $1,250, no tax return needs to be filed. Once it gets over that amount for unearned income, then a tax return needs to be filed for that child. Now, there's different tax rates that you have to pay depending on the amount of investment income being generated in the child's name. So under $1,250, no taxation because there's no tax filing needed, covered by the standard deduction. The next $1,250 over and above that initial threshold is taxed at the child's tax rate. And then once you get above $2,500 in unearned income, those amounts are taxed at the parent's tax rate, which triggers what's called the kiddie tax. Because that was a lot of numbers, I'm going to show you a summary chart. So if the child's investment and total unearned income is between $0 and $1,250, it's covered by the standard deduction and no taxes is due. If the unearned income is between $1,250 and $2,500, it's taxed at the child's marginal tax rate. And once you get over $2,500, it's taxed at the parent's marginal tax rate due to the kiddie tax. Now we're going to spend some time going over kiddie tax, how it works, and why it exists. The IRS put kiddie tax in place to prevent parents that are in very high income brackets shifting assets and investment income down to their children, which were in very low brackets. They got to pay that at a lower rate. So they basically said, look, if the children that are dependents and minors have investment income over $2,500, then is going to essentially be taxed as if the parents were earning it at the parent's tax rate. And for purposes of this kiddie tax, it's any minor child under the age of 18 and also any full-time students under the age of 24 that are being claimed as a dependent on the parent's tax return. A quick clarification, kiddie tax is only triggered for unearned income earned by the child. It is not triggered by earned income. So if the child has, let's say, W-2 employment or some other income that's actually earned income, that does not trigger the kiddie tax. It's just the unearned income side of the equation. And if they do have that kiddie tax, they have to file with the child's tax return this IRS Form 8615, which essentially shows the parent's taxable income, calculates the rate that unearned income above that $2,500 is going to be taxed at, and then the child has that tax liability. The reason why it's important to acknowledge the difference between unearned income and earned income is we do have clients that own businesses. Sometimes they will employ the children, even as minors, to work in the business. And if they have earned income, then that income can potentially be protected by the regular standard deduction of $14,600 in 2024 for an individual filer, which is separate from unearned income that is being generated by these UTMA accounts. Knowing how the income tax implication works for these minor children, these UTMA accounts, can definitely influence investment strategy when we're allocating these UTMA accounts for children. Because ideally, if we know the parents are in a very high tax bracket, we want to invest in something that's not going to generate a lot of investment income like dividends and interest, because we know it's just going to get knocked up into the parents' higher bracket. So a lot of times you're looking for investments that don't kick off a lot of dividend and interest income and are looking for the appreciation. And you also have to be careful about short-term versus long-term capital gains, because if you realize a big short-term capital gain that's over that $2,500 threshold for the kiddie tax, that can then be taxed at the ordinary tax rate to the parents, so you just have to be careful. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.